Now, a couple questions came up that I wanted to address related to the spending plan. And I know a significant number of you are either variable compensation or self-employed. So I did want to talk about, well, how do I budget if I get a bonus and it's a significant part of my money, or I have variable compensation? I think that's really great questions. I get asked that a lot. And actually, if you Google the advice, it's horrible. Like the first five Google, I was checking just to make sure, and it's really bad advice. So at some point, I'll write an article about it, and hopefully, you can all share it, and maybe we'll get on the Google list. But I want to give you two examples and some tips for those of you that don't necessarily have that steady paycheck coming in regularly. So both of these examples are going to work around the assumption that it's $100,000 take-home pay estimate, and you can fluctuate this around whatever your reality is, but just we'll work on that assumption. So in the first example, we have an $100,000 target where $50,000 is base salary, and another $50,000 is going to be their target bonus, right? So that may or may not be the case. Could be higher, could be lower, but that's like the target bonus is what we're going for. So common question would be, hey, a significant amount of my income here is based on bonus. How do I budget when I don't necessarily know what that figure is going to be? Well, naturally, a lot of it is going to depend on how your bonus is paid out. So that's monthly, quarterly, annually. There's some changes that we're going to have to make related to that. But really a super helpful starting point that you can go through. Everything we've done so far is great. Obviously, you still want to know what your expenses are and everything like that. But the way you can be practical about figuring out if this number, right, that target income, like if you're living within your means, a way you can be more practical about that is, keep your 50,000 base in place, but then multiply your target bonus by 0.75. So really take 3/4 of that target bonus, and that's going to be your, quote unquote, living income that you would work around and plan around. So that's what your spending plan would use as your actual take-home pay. And doing that is going to change the numbers pretty significantly, right? So as opposed to having 50,000 as your 50% figure, you would take the 50% off of 87.5. So you are reducing, obviously, your budget amount rather significantly by doing this, but there's a number of huge benefits to the process. So number one is by reducing this now, you're obviously going to be conservative in your estimates and therefore saving money. But what you can do is when you hit those targets, so let's say you do get 100% of your bonus, you can then start including, and I'll draw this out for you, but you can then start shuffling that money to the extreme on your emergency fund. Okay, so your emergency fund, you'll hear typically you want to try to get anywhere from 3 to 6 months of expenses piled into that account. And that's typically if you're, for example, if you're single and no one depends on your income, this 3-month target is like the great starting point. And then also that would be like if you're married and no kids, that 3 months is great because then technically it's like if one spouse were to lose their job, they're kind of going to get picked up by the other spouse. So like anytime there's no one depending on your income, that 3 months is at least a good starting point. But then as you get into the dependent stage, you really want to increase that because you're going to then have people counting on you for money. So that's typically that 9 to 12 months. So you use those as good benchmarks for your emergency fund as you're starting to tuck away savings. And think of it as, no one relying on your money, you're in this space, whereas people are relying on the income that you take home, you're in this space. And in any event, as you plan around this with the variable compensation component, you want to be really like pounding your emergency fund with any excess savings that you have, right? You'd be trying to get that much faster even than your typical W-2 employee. And what you can do is as you hit that target, then start shifting the percentage. So for example, if you're doing 75% for the bonus, well, let's say you hit that three months. Well, maybe now you've moved it to 80. right? Then you're trying to get to 4 months. Okay, maybe now you're 85. Then to 5 months. Now you're at 90. I'd sit at 90. I would not recommend going to the full 100. Just, there's too much variability, and always being conservative is great. But as you're filling those emergency fund months that much more, giving yourself that cushion, you can slowly start to reduce that. And this was something, especially when I was working in New York, I had a lot of variable, bonus-based sales clients. And when we would go through this worked really, really well. The other example is just, I'll touch on this one more briefly because the concept is very much the same. But if you're 100% variable comp, so, using that same $100,000 person, in this case, we said, okay, let's move them though to that same 3/4. So they're really budgeting off of 75,000. So that's even more aggressive than the 87.5. But again, their comp structure is even more at risk because it's entirely variable. So you're kind of matching that risk with the prudence of aggressive budgeting. And then same line of thought, ideally, let's say you get that 100% payout, you're just pounding the emergency fund to get it even higher if you can. And then as that thing increases, you can creep up that percentage. And again, I usually recommend not going up above that 90%. That's typically a great place to sit at when you have that type of variable compensation. So hopefully that gives you some helpful insight into some actual prudent planning around variable compensation. Most of the articles online basically tell you to just plan the exact same way as anyone else does, which I think is entirely inappropriate. You don't have the same compensation system. It just is what it is. So unfortunately, I think you do need to take some more practical steps to set a more aggressive buffer. The W-2 employees, you're still going to try and get to that 3 to 6 months of emergency fund, but you don't necessarily have the same aggressive requirement to do so, just given the less volatility in your earnings.